Hi, welcome to Know the Risk. I'm Walter Jackson.
And I'm Emily Bradford.
We're licensed insurance producers in the state of Pennsylvania. We're here to help you understand something that you pay for every month, something that's very important and protects you, but something most people don't know very much about, your insurance. Before we get started, I want to let you know that this show is based on things that you need to know, and our content revolves around you. So please make sure to visit us on Twitter, Facebook, and YouTube, and ask questions so we know what you need to know. This is a typical insurance policy. This is approximately what most people know about their insurance policy. We're going to fix that. We're going to try and explain your insurance to you in simple terms, and hopefully once we're done, you'll understand a little bit more about the thing that protects you so well. I'm going to hand off to Emily, and she's going to go through our first segment.
So today we're going to be talking about the risks that are involved with the hot, warm summer months. Topics like your responsibilities if you're having parties or picnics, what liability might come into play if you have a swimming pool, and other things that you can do to help keep you protected as well as possible. In the second segment, we'll answer some questions that you guys actually sent in to our social network. So before we get started with any topic, first off, the most commonly asked homeowners question: how much insurance do I need? Well,
that's a good question. Unfortunately, there's no straight answer for that question. Most people don't know how much insurance they have. They don't know how much insurance they need. Your agent is the person that can help you with that. The most important part of your insurance is the liability. That's where you're going to be protected from lawsuits, claims, things like that. You want to have a conversation with your agent, find out what your assets are, what your potential exposures are, and then come up with a limit that's good for you. So unfortunately, I can't just tell you you need $100,000 and be done with it. Have the conversation with your agent. They know better, and they should be able to help you get the proper coverage levels. Well, we're going to do our first topic today is parties. Everybody loves parties, and especially in the summertime. We have grad parties, picnics, potluck, pool parties, the occasional my parents are out of town parties. So here's the question: what's the risk? Let's take the grad party, for example. You invite your friends and family over to celebrate your child's graduation. It's all your friends, all your family. What could possibly go wrong? What's the risk there? There's plenty of risk, honestly. What if someone falls down your stairs? What if your dog bites someone? What if your new grad's best friend leans back too far in his chair and falls and hurts himself? Those are all your responsibility, unfortunately. So your homeowner's policy has a couple coverages built into it to help you out there. First off, you have your med pay coverage. Usually your medical payments coverage will be anywhere from $1,000 to $10,000. We call that the friend keeper coverage because it's coverage designed to help your guest in the event that they get injured on your property, but they don't want to file a full-blown lawsuit. Make sure that you have the appropriate level there. Talk to your agent, let them know how much you entertain, the kinds of things that go on in your house. Then they can help you decide how much medical payment coverage you need. Beyond that, we've got your liability coverage. Liability coverage is typically $100,000, $300,000, denominations of $100,000, but that's where your main coverage comes into play. If you get sued for something that happens on your premises, your liability coverage is what's going to kick in for you. So talk to your agent, make sure that they know all of your potential exposures, and they can help you appropriately adjust your liability coverages. Emily?
So our next topic is swimming pools. Everyone loves to cool off in the hot summer heat in the comfort of their own swimming pool. Somebody and other people like to cool off in the summer in somebody else's pool. So how does this affect the pool owner and their homeowner's policy? Like Walt mentioned before with having people over, if someone gets hurt in your swimming pool, then your liability comes into play. It's a good idea to carry higher limits of medical payments and liabilities just to make sure that you're covering any situation that may arise, especially if you're having pool parties often. So here's the obvious statements. Keep children away from the pool when unattended, and always keep your pool locked or closed when not in use. And yes, pools should always have a lock or fence around them when not in use, no matter if they're above or in-ground pools. It's always good precaution to have a fence around to keep any young children or unwanted guests by using your pool. Some municipalities actually have certain ordinances or laws in place with pools and fences. So make sure that you check with them before installing a new pool. We could do a whole segment on swimming pools and what coverages you should have in place. So maybe if we get a lot of feedback from you guys, we will do that in the future. But in our next segment, we'll be answering some questions we already have from you guys. So stay tuned.
My work over the past decade with college graduates exposed two troubling patterns. First of all, too many of the applicants that were seeking a degree were simply unprepared. And secondly, too many of the college graduates, once they finished, simply lacked the skill set that employers were looking for. In addition, many of the college graduates now are just drowning in unprecedented levels of school debt. The school debt has reached the $1 trillion mark, which is now second only to home mortgage debt. This perfect storm, if you will, of rising school debt and the skill disconnect between graduates and employers was the motivation for my book, Joe Barista, PhD, which highlights the state of American education in the 21st century. It chronicles the educational struggle and journey of a young man who grew up deep in the heart of the Appalachian Mountains, only to find himself an overeducated, experience-deficient graduate who was saddled with a mountain of school debt and no viable job prospects. I also realized through this time working with college graduates that many of these issues could be avoided if we could simply start the career development conversation at the secondary school level. This led to the creation of the TV program, Your Future, Your Choice. You know, there's an old adage, think global and act local. Well, local for me is BPTV. The process was surprisingly simple. I came in and pitched my idea to BPTV, and once accepted, we were off to the races. David Cable and his staff are professional, accommodating, and creative. I literally tell them what I want, and they make it happen. I'm Emmanuel Romanis, Principal Consultant at Forward 21 Career Consulting, and the creator and host of Your Future, Your Choice on BPTV.
Welcome back. We're going to answer some questions that we actually already got from you guys on our social network. So if you have a question in the future, make sure that you visit our Twitter page at Know the Risk 101 or our Facebook page to send us your questions. So our first question comes in from Jamie C. She wants to know, what breeds of dogs are on the no-go list for homeowners? Well, I really don't like the phrase no-go list. Some insurance companies will not write a homeowner's policy with certain dogs, and some will if certain conditions are met. So you have to make sure that you check with your own insurance company to see where they fall in those too. But there is a magical list. So I'm going to run down the list to know what types of dogs are a little more considered risk than others. They include Alaskan Malamute, Chow, Doberman Pinscher, German Shepherd, Pit Bull, Rottweiler, Siberian Husky, Wolf or Wolf Hybrid, and any mix of these breeds. But what I did find out, which is kind of funny, is that Alaskan Malamutes and Siberian Huskies are okay when in Alaska. So if you're in Alaska and have a dog sledding team, then you're good. But if you're trying to do that in Pittsburgh, I think you should try to check with your insurance company first. Again, always check with your insurance company whether your dog is a no-go or just certain conditions have to be met, such as fence, number of dogs, and other details that may be looked at. Walt?
All right. That was good. My dog is not on that list. So I'm
Good.
safe. Chihuahuas aren't scary, I suppose. All right. The first question I have here is from Alex Z. from Upper St. Clair. Thanks, Alex. Is it better on your premium to store your boat at a marina or a private residence? This is probably the hardest question that we got because there's not really a firm answer on this. It's going to vary from insurance company to insurance company. There are certain risks that you have when you have your boat on your property. How is it secured? Where is it stored? Is it in the garage? Those sorts of things. If you have a driveway that's at the edge of a hill, what if the boat falls down, rolls down the hill, and does damage? These are all considerations you have to think about before you decide where to store the boat. And there are also considerations that are going to come into the premium. So talk to your insurance agent and ask them to quote it both ways. And you can come up with the best premium from there. The more important thing to think about there is where is it going to be the biggest exposure for you? Because if it's in a marina, the chances of hurting someone with your boat are a lot lower than if it's just sitting in your driveway. I hope that's a good enough answer for you. But like I said, check with your agent and he can help you come to the best resolution for that. Emily?
Luckily, I don't have a boat, so I don't have to worry about that. Just my
Unluckily.
swimming pool. So our next question comes from Brett C. He wants to know if his pool floods the basement, is he covered? So there apparently are a lot of unanswered questions about pools. But before I answer that, I want to remind you guys that our answers are based on what most insurance companies do. So always check with yours since they may vary from what we may be saying. But to answer your question, Brett, the damage to your basement and your personal property are covered, but the damage to your lawn and pool are not. Most homeowner policies actually do state do not cover land, including land and where the dwelling is located. So to make this even more confusing, your lawn would be covered if it is damaged by a named peril, such as fire, riot, explosion, vehicle not owned by you, or vandalism. But this amount of coverage is usually small, only up to $500 usually. But if the swimming pool caused the damage was leaked because of a leak actually in the pool, that would not be damaged. But if the leak was caused by a named peril, such as a tree falling on your pool, then it would be covered. So I hope I made sense on that question, Brent. I hope I didn't lose everybody on answering that. But Brent does have a second question too. What effect do pools, trampolines, tree houses have on liability and premium? First, Brent, if you have a tree house, Walt and I will be over in an hour. But seriously, pools, trampolines, and tree houses are what the insurance world likes to call attractive nuisance. Meaning, all of them are usually pretty awesome, but they do present a really high risk. So most insurance companies do charge a little more for pools. Again, in ground or above ground does not matter. Usually, I didn't see anything that says that there are any kind of higher premiums for tree houses. But sometimes insurance companies won't even write a policy with a trampoline. Again, some do and some don't, depending on conditions that are met. So always check with your insurance company. But if an inspection is done on the property and you have one of these attractive nuisances, you can run into some potential issues with your insurance companies. So these issues can include if you have a trampoline without a surrounding net or a fenced yard, if you have a treehouse greater than 3 feet off the ground or less than 3 feet if not well constructed, or a yard or pool not fully enclosed with a 4 feet or above fence, and a pool entry that does not have a proper lock or latching mechanism. If you have any of these present, your insurance company can ask you to fix them and or actually cancel your policy. So the best advice if you have one of these issues is to review your liability and medical payments to protect any kind of a situation. And also make sure if you have one of these mentioned instances above to try to fix them and get them off your property so your insurance company doesn't knock down your door. Walt?
All right. I'm glad I don't have a trampoline, but that treehouse sounds awesome. We have a question here from Joanna D. from Bethel Park. She wants to know, do I have to schedule my jewelry to make a claim for mysterious disappearance?
Uh-oh.
Okay, first of all, let's define mysterious disappearance. Mysterious disappearance is a disappearance that's mysterious.
Oh.
Pretty much, right? If you use the bathroom at the gas station and you take your rings off to wash your hands and then you leave and you forget it there, that's a mysterious disappearance. If you know your ring or your earrings were in your jewelry box 2 days ago and they're not now, that's a mysterious disappearance. If you just drop it and you know that you did, it's not a mysterious disappearance, but it would still typically fall into the same coverage. The answer to the question is yes, you do need to schedule your jewelry to get the protection that you need for your jewelry to be insured against mysterious disappearance. Another good reason to insure or to schedule your jewelry is that most insurance policies have a pretty low limit as far as what they'll pay out for each individual piece of jewelry. Most insurance policies have a $2,500 limit overall. So if you've got one item that's worth $5,000, typically you're only going to see about $1,000 from that. If you lose 3 items, each one's worth $1,000, you're probably looking at just the $2,500. So if you want to be properly protected for the full value of your jewelry, you absolutely want to schedule it. You can also schedule other items like musical instruments, if you have an expensive stamp collection, a coin collection, items like that. But anything that you have that's unique and that has a value higher than what would be typical, you want to at least talk to your agent about scheduling that item. The worst thing in the world, well, I'm sure there's worse things, but a terrible thing would be to have something that's irreplaceable or very hard to replace and have that go missing or go up in flames and find out that you can only recover a small portion of what it's worth. So, Emily, you have any other questions?
I actually don't. I wanted to take it back to the list to see if you have anything else.
Okay, I do. I do have a few questions here.
More popular than me.
All right. Sherry P., she has 2 questions. The first one is, do exterior items need to be up to code? Her examples are decks, pools, etc. This is a good question. And I think this stems from most people's perception of a home inspection. When you first get your new homeowner's insurance policy, in some cases the insurance company will send out an inspector. A lot of people are expecting someone to come out from the building department or something looking for the wattage of their electrical system, or if their stairs are enough inches apart, things like that. That's not what your insurance company is looking for. When the insurance company sends out an inspector, they're looking for open and obvious hazards. Do you have huge cracks in your sidewalk? Are your stairs precarious? Is the wood on your front porch rotted? Things like that. They're also looking at your roof. They want to know if your shingles are old and they need to be replaced, because a typical type of claim is a water damage claim. And if you've got old shingles, you're more prone to have some flooding in your attic. So those are things that the insurance company is looking for. They're not necessarily looking for the things that a building inspector would be looking for on a new construction home. So I hope that answers that question. Sherry's other question, and I'm seeing a trend here, is my jewelry covered on my homeowner's policy, and what type of appraisals are accepted? I'll take the easy part first. What type of appraisals are accepted? That's going to vary company to company. Usually they'll have written in there in your policy what type of appraisal, how old it can be, who it can be from. You can't go to your neighbor and say, hey, will you write something up and say that my ring is worth $20,000? Insurance company obviously isn't going to accept that. But check with your agent. If you're thinking about scheduling items, you're going to be speaking with your agent anyway. So just ask them what type of appraisal you should have. It shouldn't be very difficult to get one. And usually the insurance company will make it fairly simple to get an appraisal and submit it to them. To answer the other part, is your jewelry covered? I think I just talked about that a little bit. Yes, your jewelry is covered, but it's subject to lower limits typically. Like I said, most insurance policies have a provision for jewelry that won't pay over a certain limit. And like I said, that is typically $2,500 with $1,000 per piece of jewelry. So that's another case where you want to look at what your collection is and seriously consider scheduling your jewelry. There's two ways to do that. You can schedule each piece individually, or you can do a blanket schedule that'll cover all of your jewelry. If you know you have $20,000 worth of jewelry, you can just do a $20,000 schedule. But if you know one particular item is worth $15,000, you may want to schedule that one in individually. So I hope that answers your question, Sherry, and thank you for writing in. I have a question for you, Emily.
Okay.
All right. Chipper from Wish It Was Pittsburgh asks, is that even a real place? Wish It Was Pittsburgh?
Everywhere else but Pittsburgh?
He wants to know, why does your credit rating affect your premiums?
Oh, geez. I get this question from so many people and so many customers. Yes, your credit rating is a factor. It's one factor. Keep in mind there are thousands of variables I can't even go into on insurance companies look when determining your premium at first. But credit is one of them, and here's why. Credit report is kind of a background of you. So it shows how responsible you are financially, obviously, but just responsible in general. Do you have a lot of high credit card limits out there, or are you trying to keep them down and be good about it? Do you have any delinquencies? How many times are you trying to open up credit cards? I mean, all of that stuff kind of goes into giving a nice kind of background on how you have been responsible in your life prior. So it is a factor. Again, if you did kind of mess up in the past, but you're working on it, we're not going to give you a horrible score just because and say, go away. It is one indicator. A lot of other things do go into consideration. Obviously, the type of vehicle you have, home, where you do live, driving history, things like that. So it does have a little bit of a play just for a background snapshot on, how responsible you've been living your life. Because obviously insurance companies are trying to be, responsible with you if something would happen. So they would like to know they're working with a good person. That's a good question, Clipper.
Chipper.
Chipper. Oh, well.
I think we're going to have another question from him next week. How do you properly pronounce my name? All right. We've got one last question here. This is from Alex Z from Upper St. Clair. And his question is oddly specific. Given a person's total income to debt ratio, what is an appropriate level of life insurance? This is a fantastic question. Unfortunately, there's not a great answer for this question. Life insurance is very, very particular from person to person. My life insurance is very different than Emily's insurance. And it's going to vary. The amount that you need is going to vary from the amount that your wife needs. This is something that people really need to have a long conversation about. Life insurance isn't something that you can typically go online and buy, and there's a reason for it. There's a lot of things to consider when you're getting a life insurance policy. How much money do you make? How much do you need to leave to take care of funeral arrangements or final arrangements? What is your family going to need in the event that you're not there anymore? These are all things that are going to vary from person to person. If someone makes $1 million a year, obviously their family is going to be in a much different position if they're gone and they don't have the appropriate level of life insurance. So this is a conversation, again, we keep saying this, but this is a conversation to have with your agent. You want to sit down and be prepared for a pretty lengthy discussion. Life insurance it brings something in that most people don't want to talk about, and that is their eventual mortality, and that can be a sore spot for a lot of people. But if you want to be properly covered, it's something that you're going to have to consider. We're not on this planet forever, unfortunately, so it is best to make the preparations for it. But I can't give you an answer. I can't just tell you get $50,000 and you'll be okay. You really want to sit down with your agent. Just throw everything out on the table. You really want to let them know what your debts are, what your assets are, what your potential liabilities are, and what status do you want to leave your family in the unfortunate event that something were to happen. That being said, I would make the phone call, have the conversation. It's always better to do that sooner rather than later. Alex also asked, when's the appropriate time to switch from term to whole life insurance, or why should I buy either? This is another good question.
Yeah.
And Emily, we can kind of bounce these off each other.
Well, again, I think these are great questions. A lot of people don't even like talking about life insurance. I don't like talking about it, but I do it every day with my customers just to make sure that you do have the conversation at some point. The earlier, the better in certain situations, just because insurance isn't something that, or life insurance isn't something that changes drastically from company to company. It's pretty much based on your medical past and your age. So if you can lock in rates when you're younger, it's usually the better case. So when to switch, I think, is kind of one of those, well, what's going on, in your life, kind of a situation, what your budget is, your financial status, how old you are, medical, reasons. Is something going on where you think in the next 5 years it might get worse? Things like that. Again, you gotta call your agent, your insurance company, or even send us some ideas on what you're dealing with, and maybe we can reach out to you and see if there's something that we can do for you. I think that's a really good segue into me talking about what we're going to do next episode, which is life insurance. It's something that they should have taught us way back in school that never did. So we will do next episode on all life and try to answer some questions. I know we've kind of been very vague in some answers today, but we will try to at least dig in and give you a little bit more of a peace of mind on what you should look for when looking for life insurance. So I want to go ahead.
Before we cut that off, if we can just reiterate, the age part of it is huge. So you're never too old. You're never too young to get life insurance, and that's something that a lot of people don't think about. People in their 30s, early 20s, you're indestructible, right? You're never going to die, but that's not true. We all know that, and you're much better off trying to get your rates locked in when you're young, because when you're a little bit older, when you're 45 and you're 50, you're going to see that your rates are going to be substantially higher. So we'll talk about that a lot more in the next episode. But for now, we'd like to thank you guys for tuning in. Thanks for the great questions. And please, again, visit us. We're at Know the Risk 101 on Twitter. Facebook is the same. And our YouTube channel will be up shortly with this episode and some other shorts that we have. So please, if you like the show, rate us 5 stars or whatever you think. But please don't hesitate to ask the questions. We need the questions because we're here to tell you what you need to know.
And now you know. Bye, guys.
Thanks a lot.